What's up YouTube? I'm Casey with bestinvestingapps.com, and after a long break I am back with you. Today we're going to be talking about portfolio turnover thanks to a YouTube question. Leave some questions and comments. I definitely want to answer your questions. You're all asking some really good questions. I try to make sure I reply to everyone directly, so hit me up with those comments and leave some questions. It's been a long journey back to Michigan from Utah. My old Subaru decided to take a dump on the way back. Things have been a little hectic. I'm settled back in and we're getting back into making videos now. So at the end of the video, I'll be sharing a link with all of you for my ebook, Get Started Investing in 3 Easy, Simple Steps. And let's get right into portfolio turnover ratio and what that means to you in choosing a mutual fund. The portfolio turnover ratio is a relatively simple formula, although I had to look it up to double check before we talked about it. Essentially what happens is the calculation is a derivative of the number of shares bought or sold divided by the net asset value of the fund over any given period. So if we go over to Morningstar, by the way, we've got the new Morningstar here, the new layout, kind of nice, I like it. And we find the turnover ratio of VTSMX as 4%. So 4% means that on average this portfolio holds a security for about 25 years, because 100% divided by 4% gives us 25 years. The period of measurement is almost always a 12-month period or a year. If that 12-month period is measured differently, then the result will be skewed if you try to divide that and figure out how many years. But in this case, it's a yearly ratio, so we can divide 100 by 4, and we know this portfolio normally holds for about 25 years. This portfolio has a turnover of 34%. Let me bring up in fact, I'll do it right here so you can see. Let's see, 100 divided by 34 equals 2.9. So on average, PARWX holds for about 3 years. So why do we use turnover ratio to measure the viability of a mutual fund for our portfolio? Well, the higher the turnover ratio, the more frequent the fund is buying and selling. So we saw that PARWX is, they're buying and selling almost every 3 years compared with 25 years for a more passive fund. And every time a fund buys and sells, just like we have to pay commissions, they also have to pay commissions. And these commissions, so like, if I go to E-Trade, it costs me $7 to buy and sell. Well, it costs the mutual fund money to buy and sell as well, but that's not really advertised. That doesn't go into the expense ratio of the fund. So that is an expense that the fund incurs that we don't really see, so that drags down the returns of the fund. Really high turnover ratio funds can sometimes be dragged down by these expenses, these trading and commission expenses. The other thing to watch out for is that every time a security is bought and sold, there is a tax implication. If you are holding these funds in non-tax sheltered accounts, so if you're in like a personal brokerage account, a normal brokerage account, you will be subject to taxation because the fund is buying and selling securities, and that comes through, it gets passed on to you. If you're in a Roth IRA, a traditional IRA, or some other type of tax advantaged saving or investing account, then you don't have to worry about that so much. That's why I choose to hold like PARWX. I hold that in my Roth IRA because the Roth IRA is sheltered from those resultant taxation on turnovers. So if you're going to hold high turnover funds, hold them in a tax sheltered account, or make sure that you are earning your keep with those. Make sure that the fund is returning really, really well to cover the cost of those taxes and those commissions. One more thing to keep an eye out for is that actively managed funds do not always have the same turnover ratio. If you remember on PARWX, we saw a 34% turnover ratio. Let's go and we're going to click on the performance tab here on Morningstar, and then we can come and we can look at the last few years, and you can see the turnover ratio historically. We come down and turnover ratio is right here. In 2012, they had a 69% turnover ratio. So that means 69% of your returns would be taxed at your tax bracket rate if you're holding this in a normal investment account. So if you make $1,000, they're going to tax 690 of those dollars at your tax bracket rate. If that's 30%, then you're paying 30% taxes on 690 bucks. Sorry if that math doesn't quite make sense. Basically, what I'm saying is that whatever the turnover ratio is for a given year, you're going to be taxed on that if you're holding it outside of a retirement account that's tax sheltered. You can see here it's 41%, 40%, 63, 34. 2016 was the lowest year in recent memory for turnover, which means good things for taxes. These kinds of years where we've got turnovers on the 70%, that means bad things for taxes. So watch out for that. Make sure that you're using these in tax advantaged accounts where it makes sense, or make sure that you have a real strategy if you're going to use them in a different type of account, because these taxes can kill your returns. 30% in taxes on a 10% return absolutely blows that return down, takes it all the way down to 7%. Nobody likes that. So be aware, keep an eye out for that, and that is what you need to consider. So if you're looking for mutual funds with low turnover ratios that you might want to hold in a non-tax advantaged account, how do you find them? Let me help you out. I'm going to make sure that I link in the show notes below to the Yahoo Finance Mutual Fund Screener. Let's get into it. I added the NYSE here in the Exchange Is column. So I'm going to click here. I'm going to add NYSE if it's not already on there. And then we come down. I chose to add in the 4 and 5 star elements. You could leave this blank or change it to your own needs. I'm going to get rid of intraday price. Don't really care. Don't care about fund family. Don't care about category. And then I'm going to add another filter. Click on turnover ratio, close. Turnover ratio is, let's say that it's less than 10% for good efficiency. And then I'm going to click find mutual funds, which is hiding behind my big head. Roll down through here and bam, here is every mutual fund listed on the NYSE or the NASDAQ that has a turnover ratio less than 25%, is 4 or 5 star rated according to Morningstar, and we can add more or less filters to our needs. And we can go in and we can look at different elements here. So I can filter by different elements. I can see all these different ratings. This is a great way to start finding mutual funds with low turnover ratio, but you could flip this whole process around. You could look for mutual funds that are really actively managed with high turnover ratio if you wanted to. So use this, check the show notes below for the link, and use it to your advantage. I've got a good short little article here from Investopedia about this exact topic, how to use turnover ratio to help judge a mutual fund. I'll link to it in the show notes below. I'll also link to my ebook, Invest 3 Easy Steps for the Beginner Investor. That'll be down in the show notes. Check for that. Remember, the essential elements of including turnover ratio in your portfolio choices are the effect of the turnover ratio on returns, as well as the effect of that on your returns in a non-tax advantaged account. If you can find a mutual fund with a high turnover rate with an extremely good return and good track record, it may be worth your time to consider that. If you find a mutual fund where it's equal to another mutual fund in all aspects, and one has a lower average turnover ratio, you might consider that lower turnover ratio to be a good thing, especially if you're looking at it in a non-tax sheltered account. Look for index funds whose turnover ratios are usually extremely low. So VTSMX is a Vanguard index fund. It has a 4% turnover ratio that you can see right here. Extremely low, good for non-tax sheltered accounts, good for your returns, if that makes sense for you. Remember to go check out bestinvestingapps.com, and we'll see you next time.